welcome everyone. Today we will be talking with Larry Taylor, and we will be discussing the Los Angeles real estate market outlook and investment opportunity. So I wanted to give you a little brief about Verivest in case you haven't heard of who we are yet. We are a real estate investment platform designed to bring transparency and trust to middle market investing. Our mission is to create and enable the conditions to increase the speed of trust in the private middle market real estate investment space. And our goal is to help enable investors to direct capital to those sponsors and managers who can objectively demonstrate they are trustworthy stewards of the capital. So here is the sponsor directory. You can search by areas. I see Los Angeles actually right there. You can also search by minimum investment types. You can see background checks there for the last 10 years. And then you can also connect directly with a sponsor through the site. All right, so verification requirements. So there's Verivest Gold and Verivest Verified. So to be on the platform, you must have no personal or business bankruptcy petitions, no unfavorably resolved lawsuits, no regulatory sanctions in the past 7 years, and no felony criminal convictions in the past 7 years, and sign the Verivest Code of Conduct. So I don't want to take too much of your time because we have Larry or Lawrence Taylor on the line. He is a seasoned investor with 45 years of real estate experience in West Side region of Los Angeles. Notable projects include the introduction of high-rise residential development in North Century City, the development of Montana Avenue Shopping District in Santa Monica, revitalization of the South Beverly Hills Retail Shopping District, and redevelopment of Westwood Village. He received his Bachelor of Science degree from the University of SoCal in 1975, and he is the founder and Chief Executive Officer of Christina. So he is responsible for all the vision, the strategy, and the leadership as well. So here's my information if you want to learn more about Verivest, and then I will go ahead and stop sharing and let the expert take it away.
Thank you, Brittany. I appreciate the opportunity to be with you today and your audience, and to be able to chat a little bit about what is my favorite thing to do. Buy, own, invest, and operate real estate in what I think is the best area of the world, Southern California, particularly West Los Angeles. The slide that we have up in front of us is just a little glimpse to show how many years we've been active in this marketplace. I am sitting here looking at the Pacific Ocean and have had this little perch here for more than 40 years. The West Side region of Los Angeles is probably the most misunderstood geographical area amongst many people, because when people think of Los Angeles, they really either think of Hollywood, or they think of downtown, or they might think of Beverly Hills. But Los Angeles is one of the rare major metropolitan cities in the world that does not rely on a central city core. And whether it's Minneapolis or Chicago, Dallas, Miami, New York City, San Francisco, there's a defined downtown, and then there's the suburbs that grow out, generally concentric circle, unless they're up against Lake Michigan like Chicago. But the core is the pulse, and everything radiates from the pulse. Los Angeles is nothing more than a series of cities connected with freeways and streets. It's never had, in the last 100 years, it hasn't had public transportation to speak of. And the West Side region of Los Angeles, which comprises at least 5 separate incorporated cities, as a landmass would be larger than the island of Manhattan. And so it's a vast area, and yet it also represents some of the most exclusive, most high demand, most highly sought after, most valuable real estate in the world. It also boasts the best climate year round in the world. It's also home to the ports of Los Angeles, Long Beach, which represent the highest rate of traffic from the Far East in the entire world. We bring in most of the products from the Far East here. We're closest to China, our second largest economy in the world. And so when you combine that with tourism, you combine that with technology, aerospace, entertainment, we're the entertainment capital of the world. The demand has consistently exceeded the supply since I became involved in the west side of Los Angeles real estate, maybe as many as 49 years ago, although Christina's only had 45 years, but I was investing before that. So today, the west side region of Los Angeles has no vacant land. The last major parcel of the land, which was owned by the Howard Hughes Corporation for a long period of time, is now known as the community of Playa Vista. It's fully developed. There's no vacant land, and yet the demand continues to exceed supply. And we have the highest concentration of wealthy individuals in the world in the west side of Los Angeles. So we're very, very focused on Beverly Hills, Century City, West Hollywood, Malibu, Santa Monica, Playa del Rey. These are separate, most of these are separate cities. But they're all part of the west side region of Los Angeles. And when people think of Los Angeles, it could be as far as Hollywood, downtown, Silver Lake, Sylmar. The San Fernando Valley is all part of the city of Los Angeles, going from Encino to Woodland Hills to Van Nuys to Sherman Oaks, North Hollywood. All of these areas are still considered Los Angeles, and yet they all operate under their own independent core, tied together by freeways and boulevards. So when we talk about the west side region, we're talking simply the best of the best, literally as close as you could possibly get to the Pacific Ocean, and some of the best, as I said, best real estate imaginable in these separate cities. And so our whole focus since the beginning of time from an investment perspective is that we've always been a sponsor. We've been a sponsor for 4.5 decades. And being a sponsor, there's a fiduciary relationship that's established between the sponsor and the investors. And the singular focus, of course, always is to preserve our investors' capital. And one of the ways to preserve investor capital is to buy the best real estate in the best locations and buy it at the lowest possible price and manage it the most effectively. And in doing so, we still get the benefit of what the federal government gives real estate anywhere in the United States, which is liberal depreciation and amortization rules, tax credits, tax incentives, bond financing. There's just a whole host of government support which is designed to stimulate real estate, which historically has stimulated the economy. So our attitude is, if you're going to invest in real estate, why would you do it in a B or a B minus market or a C plus market when you can do it in a AAA plus market and benefit from the incentives the government gives you? But in terms of mitigating downside risk, which every investor takes into account from the moment their money leaves their bank account, is if you're buying in an area where demand will always exceed supply, even through the last 5 or 6 recessions that we've been through, we've always had a higher high, even when we've had a depression in pricing. We've always emerged at a higher high and a higher low. So, and the entire west side of Los Angeles, which was primarily developed after World War II, is ripe for redevelopment. And because there are no vacant lots, not unlike Manhattan, if you wanted to build a new building in Manhattan, you'd have to buy an existing building, tear it down, build a new building. And that just means that the entry level, the entry cost is so much higher. And the entry barrier to building in the west side is considerably challenging because there's a tremendous amount of regulatory resistance to allowing new construction generally. And so for all of the above reasons, we've concentrated, fully focused our efforts specifically in this location. And historically, real estate investors have primarily made the most money by being geographically focused. And all of this has given rise to what we do currently, which is Christina Real Estate Investors, which we commenced, about 6 or 7 years ago. And what happens with real estate is that for an investor who buys a property and gets the benefits that the government gives for depreciation, amortization, and other kinds of deductions to shelter the income, those excess losses over that which is used to shelter existing income cannot be used as a deduction against any other form of income. Whereas prior to the 1986 Tax Act, those losses could be used against ordinary income when ordinary income tax rates were very, very high. However, and this is what happened when the law changed after 1986, is that you can use your excess losses from real estate against income from other real estate. So if you owned 5 buildings in one portfolio and all 5 buildings generated passive losses and one building sold at a gain, producing a profit, the losses would offset the gain and the tax would be essentially, it would be wiped out. So there's a lot of reasons to own multiple properties within one entity, and that's what gave birth to Christina Real Estate Investors. We recently announced the close of our 4th private equity company, and soon we'll be launching our 5th. But again, the strategy is, sometimes the greatest amount of money is made on the simplest ideas. Tesla, which is now one of the largest from a valuation point of view, is worth more than any other automobile company in the world. But Tesla is nothing more than something that was invented more than 100 years ago. The first automobile was electric. And electric cars were around in the late 1800s and the early 1900s until they discovered oil and created the combustion engine, and oil took a front seat to electricity, and now you have electric cars. There's nothing unique or special about a battery-driven motor that powers 4 wheels. So, I think the simplest ideas sometimes can create the greatest positive investment results. And our concept and what we do from day one until today has been very, very simple. Buy great real estate, don't overpay for it, know your market cold, operate it effectively, and look for multiple exit paths. So if we buy an apartment building and it happens to be a site that's better suited to be a condominium project where it's for sale housing, or if we buy an office building today, which some are becoming more attractively priced because of changes in how people work, and convert that to an apartment building, or vice versa. Right now, we bought a retail project, and we are tearing down the retail and building studio apartments across the street from a hotel, and we've got a joint occupancy plan with the hotel for their extended stay clients. But we bought it valued as a retail property, but we tripled the value by changing the use. So, we stand for value bought versus value add. In our business, real estate investors and sponsors like to talk about value add. We're going to buy a property and we're going to do something to make it more valuable. Christina's philosophy is we're going to buy a property for less than it's worth, and we're going to buy it for less than it's worth because something triggered that sale. Most of the time, great real estate is never available for sale. But when there's a death and there's an estate tax, or where there's a divorce and a need to sell, or there's a partnership dispute, or things of that nature, right, that give rise to a need to sell, that's where we step in. So we're not out there competing in the retail market and basically buying properties at market, which that's a momentum type play for investment real estate. You're just hoping the market will go up. And then if you're a value add person, you're hoping that if you can do something to the property to make it worth more. Our philosophy is it's got to be worth more on the day that it's purchased. And then whatever we do with it, we know we'll be able to make more. But if we were wrong and values happen to go down, if we bought it for 20% less than it was worth it, at least we'll be at zero, at break even, and we won't experience a loss. And so the other thing too is that a lot of people who look at real estate have never had the opportunity, and now do have the opportunity because of change in law in 2013, when the Jobs Act became law and allowed companies such as Christina to be able to market the opportunity to invest in 50 states, unrestricted. We've opened the world to between 10 and 12 million accredited investors who now have access, whereas prior to that law changing, Christina had to have a pre-existing personal or business relationship with any prospective investor. Investors, of course, had to be accredited, and there could never be any marketing whatsoever, no advertising. That world has changed completely, and that's why Christina's offerings are now growing, and the membership is growing exponentially, because we're giving access to real estate investment that was not available to most people in the United States unless they knew somebody and had a pre-existing relationship with them. So, to us, that's about the most exciting thing in the world. And there's something to be said about, owning real estate. Real estate is a tangible asset. Real estate is something that you want to own, and you want to own forever, because it's what I call comfort. It belongs in your portfolio. Most people's ownership of real estate generally is a single family home, which generally is not considered an investment more than it is shelter and enjoyment. So there's very little out there for people that want real estate. It's very hard, if you're a professional, to go buy a property that requires management and an operation, because you don't have the time for it. So people who want to own real estate generally can't operate it. And so to be able to own something and not have to operate it, but know that you have a tangible interest in something, you can't get that with an investment in a real estate investment trust. You can't get that with an investment in a fund, a lot of these funds that are available, but you don't really ever own the real estate. And the private real estate investment market in the United States, as of today, is estimated to be about 11.4 trillion. That's how much real estate is owned privately, not institutionally. It just dwarfs the REITs, it dwarfs the funds, it dwarfs the institutions. This is basically most of the real estate in the United States that's investment grade is privately owned. And so there's a reason for that, is that people don't generally sell great real estate, and people generally want to own real estate for the benefits that come with, particularly in an inflationary environment where hard assets tend to really accelerate. But we've never been what I call a momentum investor that's thrilled to make money because prices are generally inflating, but we do benefit from that based upon a leveraged situation where you can put down as little as 30% or 40% and borrow 60% and basically leverage your return. But the theory is buy it, own it, feel good about owning it. And believe me, if you own 10% of a building that's sitting on the beach in Playa del Rey, it's never going to go down in value. It's only going to go up in value, because more people are going to want to buy it and more people are going to want to rent it than there'll ever be any more product available. So that's basically where we're at and what we do. And looking at where we are now in 2021 going into 2022, a number of things have been generally pretty clear, which is the desire to shop in enclosed shopping malls is limited, not necessarily because of COVID, but more so because the United States became over-malled. There were just too many malls and too many replications of the department stores. But open air retail, street retail, which has been around since the beginning of time, which is pedestrian oriented retail streets, which are very few in Los Angeles, since Los Angeles has never been a city not whether it's the west side or the east side or the north side or the south side, it's always built on the car, convenience centers, very few areas where people walk, but there are some. And those are areas not only that we do invest in, but we think there's incredible upside opportunity. We think there will be a diminution in value of office buildings for a period of time as people, a portion of the workforce will move to remote. And we think that some of those properties can be purchased and repositioned. And by repositioning, we mean, smaller to medium-sized office buildings that, tenants who occupy suites and high rises can move to a smaller building, occupy an entire floor, and not have to share common area hallways and bathrooms with other tenants. And in some cases, conversion of some office buildings to other uses, whether that's hotels or whether that's multifamily. And then in the multifamily world, in the west side of Los Angeles, there is some minimal amount, but there is some new construction of multifamily. Very, very expensive because of the need to buy existing product, remove it, and rebuild it. But over time, because we are in a seismic zone, we're famous for being at or near the San Andreas Fault with all of its other potential risks. There's risks of hurricanes in Florida. There's risks of earthquakes here in all of Southern California and Northern California as well. But the city of Los Angeles and the cities of Santa Monica, Beverly Hills, and West Hollywood now have these seismic upgrade codes, which require owners to either upgrade their buildings or remove them and replace them. And it's almost impossible to remove an existing multifamily building because the need for housing and the sensitivity to the need for housing. But because most of these buildings are unsafe as built, we see a whole new revolution over the next 10 to 20 years of these older buildings being replaced with seismically safe buildings with modern amenities and removal of lead-based paint, removal of asbestos, removal of formaldehyde, all the things that were used over time in these older buildings, which at that time were thought to be good, which today people are very sensitive to those things. So we see a whole new opportunity to buy these existing properties, keep them, manage them, operate them, and ultimately remove and replace them under the current codes and new ordinances that are being passed. And so we recently closed Christina Real Estate Investors 4. We'll soon be launching Christina Real Estate Investors 5. And we're focusing on something a little bit different in Christina 5 that we have in previous renditions 1 through 4. And a lot of people who invest in real estate are really excited and interested in getting quarterly distributions, cash flow. And we chuckle a little bit over here when we say, well, if you want cash flow, go buy a bond. But if you want to buy real estate with cash flow, the lesser the quality of the real estate, the greater the cash flow. Just that works, because you can buy a property in a lesser area for less money, and therefore you can buy it at a lower price, and you can get a higher return, but you're not going to get, in other words, you have to give up something to get something. So if you want to buy real estate in the inner city, you might earn 10% on your money, but you're going to buy properties that are not easily saleable and they may never appreciate. So, but we've often said, look, if we just never had leverage on our properties, they would all generate a certain level of cash flow. So right now we're doing what we call a joint offering. We'll have two offerings at the same time where an investor can invest in one, or one will have traditional leverage, which will not focus on generating distributable cash flow from operations, but will focus, as it has traditionally, on distributions generated from financing opportunities or disposition opportunities. The other portfolio will be unlevered, and we will buy in that portfolio 1, 2, 3, or 4 properties, probably 3 or 4 properties, depending on the size of the capitalization. And those properties will be newer buildings They will not be capital intensive. They will not have any real demand for capital. They will be existing really high quality buildings that simply will be owned for no debt and will generate cash from day one. Now, in this way, an investor can allocate between the two. They can allocate more to the leverage side and less to the unlevered. If they allocate more to the levered, the IRR ultimately will be different because leverage will increase the return. They'll also generate higher losses, which they can use to offset some of the income, which ultimately will become positive in a non-levered fund because there'll be no interest expense to deduct. But it kind of gives a little bit of a balance to an investor because it gives them a little bit of both. But they're the same properties in the same locations, but they would be properties that would be less capital intensive, but they won't necessarily be what is the rage lately of warehousing and industrial triple net lease, Amazon, last line delivery space. No, we're just going to buy great real estate and not lever it and provide quarterly distributions. And so each one of those offerings will have a 25 million base target. They can be increased to 50 million depending on demand. So we'll raise somewhere between 50 and 100 million between the two. And we'll just continue on this programmatic series of buying these properties on the west side. As I said, we'll never be able to buy it all, but we're certainly going to try. And that's pretty much who we are, what we do. And we're excited every day because there's not a day that goes by that there's not an opportunity. It might sound a bit maudlin, but I do read the obituary every day to see if I got lucky.
Thank you, Larry, for all your expertise. I mean, this is what, 40, you said 49 years you've been in the industry. That's no small feat. So thank you. It was awesome learning about Christina. And it looks like we have a question here. How does one join the waitlist for Christina 5?
They simply go to our website and there's a button that they push and they'll immediately be asked a few questions and they'll get on the wait list.
Awesome. How do you find properties to acquire?
Well, because we've been, in business in the west side of Los Angeles for so long, they actually find us. We're a known quantity. We have a long history of performance. And when there's a need to sell a great property, we're on the list to be contacted first because of our proven track record of performance, particularly when there's an event-driven need to sell. And the only time we ever want to buy property is from a seller that needs to sell.
Awesome. How do you weigh the desire from investors to secure high returns, IRR, versus maximizing value of the long term?
Well, the reality is the greatest fortunes in real estate have been made by property owners and investors who have purchased and owned properties essentially for a lifetime. And rarely do those investors sit back and try to figure out an IRR, because an internal rate of return can only be calculated after you've disposed of the real estate. So you'll never know how much you made on an investment until you sell the investment. You buy a stock for $10 and sell it for $20, you doubled your money. But if you own real estate for an extended period of time, you really can't determine what your IRR is, your internal rate of return, unless you guess at what the current value is if you were lucky enough to sell it. And unlike other asset classes, you don't wake up in the morning and say, oh, I want to go sell my property for 50 million and sell it by the end of the day and get the check. So real estate, prime real estate, quality real estate is designed to be owned because it's tangible, it survives humans, it thrives beyond inflation, it thrives beyond recession, depression. And there's not one, I mean, here's a significant factoid is that in nearly 50 years, there's not one single property in hundreds of properties that we've owned over time that we've sold that we could buy back today for what we sold it for. So what does that tell you in a study? Nearly 50 years, if we'd only kept every property and never sold them, well, then our investors would have made many, many more hundreds of millions, if not billions of dollars just by doing nothing. And that's the secret. Buy great real estate, buy it right, buy in the right location, have a great sponsor, sit back and enjoy watching your wealth grow in a tax efficient manner. That's how the wealthy do it. And that's what we do.
I'm learning so much from you today. Larry, that's awesome.
What's the size of the properties you bought last few transactions, you know?
Oh, I think they've ranged from 10 to 25 million.
Okay. And how much you leverage on?
Well,
Generally.
generally around 50%.
Thank you, Larry. Well, thank you everyone for joining us. And Larry, it was awesome to have your expertise with us today. And everyone take care. Have a good evening.
You too, Brittany. Thanks for inviting me to speak.
Of
Appreciate
course,
it.
it was fun.